a live show every week. Sometimes we have kerfuffles, I think if that's the word, with scheduling with our guests and that sort of thing. So unfortunately, we don't have Justin Dixon on today, but we'll get him rescheduled for the future. Um, Mark and I today are going to riff on some stuff that we're seeing in the marketplace. One thing I actually wanted to share, I'm going to share my screen now, that I really wasn't aware of, but somebody that's on LinkedIn actually, Andrew Cushman, who's an absolute titan of in the multifamily space with founder and principal of Vantage Point Acquisitions, actually made a really insightful post. Go and check it out. Definitely follow him. It's definitely a great resource and a body of knowledge that I look to as somebody that's basically in his shadow, essentially. And I'll just read it here. All right. So he says, understanding the capital stack and your place in it. I unfortunately had a conversation last week with yet another friend who was about to take a total loss on a limited partner investment. LP stands for a passive investor in an apartment syndication. But this wasn't your run-of-the-mill over-leveraged deal that has become commonplace these days. This was one a bit more sinister. It's not clear my friend missed it, or if the sponsor hit it, there's a good chance the SEC will be called in to help sort that part out. What is clear is that the vast majority of LPs don't even realize the risk they've taken. The simplified version is this. My friend invested as an LP in a syndication where a sizable portion of the equity invested came from a large institutional level investor or private equity firm. Like just about all commercial properties, the market value of this particular apartment complex has dropped over the last 12 months. It's been happening in a lot of markets that experienced a lot of booms in their cycles. High growth markets had interest rates remaining stable as part of the sponsor's business plan. Didn't foresee interest rates almost doubling, tripling. They got short-term bridge debt they had a floating rate debt that adjusted upwards to today's environment. All right. So as part of its requirements to invest, the institutional level investor included a clause that allowed it to buy out all of the LP investors if any number of adverse conditions were met. The problem is, for LPs anyway, is that that investor can unilaterally decide when to buy out the LPs and unilaterally decide how much the LP position is worth. Last week, the big investor decided the adverse conditions clause had been triggered. The sponsor can't do anything about it, and neither can the LP investors. How much are they giving the LP investors to buy them out? Less than $20 for a multi-million-dollar equity investment. And all the lucky LPs get to divide that amount between them. So this is something that I really wasn't aware of. When you're a passive investor, you definitely want to be aware of where you are in the capital stack, right? There's equity, there's debt, and also there's various levels of equity, right? There's GP equity, there's LP equity, and then there's ultimately a lot of other funding sources that can come to the mix. And what's become popular over the last few years is that private equity firms that have funding sources from large institutional hedge funds can negotiate terms on the equity investments they place in there that are above the capital stack of the LPs and the GPs in a deal. And so this actually came at a timely point in my investing career. I'm an active investor, but I also passively invest in other deals in other markets because my objective is an equity multiple, not cash flow, because I'm 39 years old. I have 20 years left in me. So I'm looking to, double and triple my money over holding periods in institutional quality assets. So I looked at a deal and the deck and the sponsor was quite proud that there was a private equity company that was providing a substantial amount of the equity required for the raise. So on my follow-up, I'm not ruling this investment out, but my follow-up to that would be asking them like, all right, well, how is that equity structured to our equity as LP investors, right? Because this is why you want to be educated as a passive investor. Now, there's an active part with doing your own due diligence on the sponsor, on the deal, on the market, and also on the capital stack to make sure that you are not going to be hit by a train, an unsuspecting train, like this reference that Andrew Cushman made. So that's something that I noticed. So that's a question I'm going to ask from now on when I'm looking to invest in deals as to, what is the sources and uses, what is the total capital stack, and how the different equity levels compare to each other.
Awesome.
So did you get all that?
I missed the first couple minutes.
Well, yeah, I mean, to summarize, you're going to see deals out there that have private equity in the capital stack as part of the equity, and sometimes because these private equity firms are writing pretty large checks, they can negotiate special terms based upon their equity they place in the deal. In this case,
Yeah.
Andrew Cushman had a friend that the entire deal, the LP equity got completely wiped out because the private equity firm they had a trigger point with the strings that came along with that equity and just basically, wiped them out.
Ooh.
Which is
And
pretty
that
tough.
and that kind of falls on the operator, right? So if you've got an operator that's not really, I mean, as an L, how could you avoid that? How would you even know that those strings were in there?
You want to understand and ask the operator or sponsor, all right, cool. This is the GPLP split. This is the preferred rate of return. What other class of shares are in the deal, right? And how are those shares structured compared to the ones I'm doing? And what are the actual individual, what are the agreements or strings attached to that equity as it compares to my position? It may have been disclosed up front by the sponsor, but sometimes people just don't read this stuff.
They don't read the fine details. Yeah. So it would have been part of the private placement and they just weren't paying attention.
Possibly, or it just wasn't disclosed, because there's a lot of deals that I look at that come across my desk that, by sponsors that say, "Hey, we have this large private equity shop that's contributing a significant portion of the equity of the deal. We're putting very little debt on the place, but well, you don't know what that equity has in terms of how it is stacked on top of your equity as an LP investor."
Yeah. I find it hard to believe that they would be able to get away without disclosing that information, though. It's
Yeah, I
crazy.
mean, the private equity firm, I mean, that may not even been their problem, right? Because
Mhm.
the private equity firm probably wasn't involved with raising the LP equity.
Right. No, I mean,
They just
from the
negotiate their
operator,
own term.
yeah, from
Yeah,
the operator's standpoint, I mean, I don't see how they couldn't be liable for withholding that type of information to an investor.
yeah. So I mean, that's why I probably could trigger an investigation from the Securities and Exchange Commission
Yeah,
as
for
a
sure.
result of that, because there's probably a lot of pissed off people
Yeah.
involved.
Yeah.
So. And the SEC is not something you want to be on the wrong end of the business on, for sure.
Right. Yeah.
So, anyways, what's up, Mark? What are you seeing out there?
I'm just recovering from a little bit of a sickness, so I'm in a brain fog. I apologize if I'm not as quick-witted as normal. Um, I'm working on my development project downtown, so I've been pretty engulfed in that over the last week. I'm doing my first AIAs. The initial thing that I submitted to the bank was just like a stack of invoices in a spreadsheet, and they're like, "Yeah, this is not exactly what we were looking for your first draw." So
Mm-hmm.
we met the third party over there, and kind of ran through where we're at in the process, and he said we're actually a lot further along than he had anticipated based on the pile of papers that we gave him. So they're kind of coaching us through filling out those AIAs, and we're looking forward to doing it the way that they want us to do it.
Yeah, absolutely. So, do the vendors and the trades have to sweat until those pay apps get satisfied on those
No,
through the process?
I think we're okay. I mean, obviously they weren't paid probably yesterday, but they
Mm-hmm.
realize that it's our first rodeo as far as doing a commercial project of this scale. So they've been pretty patient with us.
Mm-hmm.
And, it was actually good news that we brought back that we're ahead and we should be able to say, my assumption was that we would be requesting draws for stuff that was not done yet. So that's not how it works. You're
Mm-hmm.
requesting draws based on progress of completed work. And
Mm-hmm.
I just kind of got everything confused in my mind because I knew I had an equity contribution that I had to make in advance of taking the draws. So
Mm-hmm.
that's where like my brain was just not thinking of things right. So this walkthrough was really helpful, and we're gonna get our first draw and keep the ball rolling. Just a little bit of a hiccup. That's it.
Yeah, one of the things that when I worked for a development company, we had on basically in negotiating with our contractors and trades is we had a cover contract, and it actually determined on that and it was a fill in the blank contract that was with all of the people that were involved with the job, So they were fully aware that there was construction financing involved, that we had draws involved, and that their pay app was due to whoever the project manager was by a certain day of the month.
Okay.
And if they missed that pay app, then they had to submit it with the next pay app. So they'd have to wait another 30 days.
What is a
And then,
pay app? Like what is that term? Pay app?
like a pay application.
Pay application. Okay.
Yeah. So they would submit their, their
Progress
pay.
billing, right?
Exactly. And
Mhm.
all of that was, had to be, signed off by the project manager, had to get, so there was a chain of approvals through that, and also inspections, for that work, so that, so it was just like, all right, yeah, we're just going to sign off on this. Right.
Right.
So the project manager was responsible in terms of being the frontline person,
Mhm.
to sign off, like, okay, that was actually complete, in in accordance with whatever milestone we set out, and that sort of thing. So yeah, it's definitely, that's the one thing in terms of a topic, right? Construction financing sucks. It's expensive. It's clunky. The pay the payouts are, it's very labor intensive. So I found through doing many projects with construction financing for the development company I used to work for, that I just want to basically either, raise all the funding up front and then just pay for
Mhm.
the project, and then, get it stabilized, leased up and stabilized, and then bring it to the bank for the refinance. And we finally ended up getting better terms through that process anyways, because now the bank didn't have to take on, didn't have to live in the construction risk with us, which
Mhm.
is what they're trying to do in terms of hedging that risk throughout the project.
Right. Yeah, the bank I'm using, Canandaigua, is actually pretty good as far as being pretty affordable. So I got no qualms there. I'm actually
Mhm.
locked on the construction, and then it's locked for the entire 5 years, and it's the same rate for the construction period as it
Mhm.
is for the perm period.
Mhm. Yeah, no, CMB is actually, I use them for like I guess I would call it like a semi-construction loan. It really wasn't, but it was, we closed the loan. It was a refinance where I was using, basically, asking for additional credit to perform some unit renovations on an apartment building that I bought. So they basically set it up as like an escrow, and it was up to the individual loan officer when basically when I hit a certain milestone, is very, very clear as to what that milestone was, that I would, submit my invoices. My individual loan officer would come to the site and walk it with me to verify that, and then he'd, send a note to the credit department to release those funds to me. So it was actually a pretty seamless process. But when you get into like these like multi million-dollar construction projects, it can be like a very, very heavy administrative burden, to say the
Yeah,
least.
yeah. I could just see, like, based on my small project, just multiplying that. Yeah, it already feels like it's paperwork heavy. So
Hmm. Yeah. So where are you at right now? I mean, I think the last time we checked in on you with this deal, I think that you had framing up. Tell us about that.
yep. So the electrician is going through now. We're kind of doing it floor by floor. So I'd say the top floor is pretty much done with the mechanics, the electric, the framing. Second floor is probably 80%. And once those two are at 100%, they'll kind of move down to the first floor. Framers should be starting on the first floor
Hmm.
next week.
Okay, excellent. So do you have like, you're having all like your mechanical like stacking, that sort of thing put in. So then all the finish, like drywall and finish work one gets done like kind of like on a floor by floor basis.
Yeah. And we decided to do a new roof too, which wasn't part of the original pro forma. It's just showing some age around where it connects to the parapet wall.
Hmm.
So we're just going to redo the whole thing. So, now that the weather's changing, we really want to get that on and done so we can rest assured that any finish work we do is not going to get impacted by a leaky roof.
Yeah, that's another thing I hate about commercial buildings is flat roofs. Because
Hmm.
even brand new flat roofs you have can be maintenance intensive, even when they're brand new. I remember we'd go to the top of a 12-story building with a brand new roof on it, and we'd find like just random like screws and broken bottles and stuff like that. And we're talking about rubberized roof, right? That that type of stuff can puncture,
Yeah,
and those
absolutely.
puncture marks too, like, are not immediately visible to the naked eye either. So you could have a leak someplace you think it is coming in over the bathroom, and you think the roof leak is right there, but it's actually like 20 feet like down the way, because what ends up happening is the water gets under it, and gets under the membrane, and then through capillary action, like, can travel underneath that membrane to a totally different spot in the building. So
Yeah.
I've like always like, I've looked at these. It's part of zoning with the city of Rochester that pretty much in all these like zoning districts where you see like new construction coming up, that they require flat roofs on all these new projects. I'm like, why can't we do pitched roofs? Like, because
Right.
they're just so much less, maintenance and maintenance intensive. While you have it, you can put 50-year architectural shingles on them, and I think that pitched roofs are more, I guess, historically appropriate, anyways. Based upon some of the older neighborhoods we have in our city, but I don't know. Who knows? I'm not in charge of the zoning department at the city of Rochester.
I think the commercial roofs, you can maintain them longer than you would a shingle roof. That's probably why they like commercial world likes the flat, because you can add preventative. I forget what the top coats are, but you can
Hmm.
extend the life of the roof pretty extensively just by doing that on a
Hmm.
somewhat regular basis.
Yeah. So that's taking up most of your time right now, I take it. What else have you been working on?
Well, we've got the city auction coming up, so I should start driving those properties. I'm kind of being slow. I didn't have a lot of fun at the last year's city auction. I
Hmm.
think a lot of the prices got ran up to pretty much MLS pricing.
Hmm.
I had a story from last year's auction. Somebody that we both know ended up purchasing a property at the auction for higher than it was available currently listed on the MLS.
Hmm.
And so, like, on the MLS, you could have went and looked at it. You could have got inside, made an appointment, had an inspection if you wanted to,
Hmm.
and they ended up bidding it up like several $1,000s higher than that list price. Like, they obviously didn't do their due diligence.
Hmm.
And I talked to him after about it, and he had some story about, yeah, I know it was on the MLS, and I know I'm just like, it didn't make any sense to me. And then you've got other brokers that have never been there before that are now showing up because of this total lack of inventory. And they're thinking that they can come in and scoop up a lot of inventory. They don't really know the caveats of
Hmm.
the city actions. And so last year, there was a loophole where a lot of these guys that went in and bought a lot of stuff were able to get out of the contract and get their deposit back. The
Oh, wow.
city's fixed that this year. So, if you go and you give them your 5 grand deposit this year, you're not getting it back.
Hmm.
So I'm interested to see, but I think it's going to be the same faces again from last year,
Hmm.
especially the new faces that have come. And I'm just not happy with the pricing. I feel like I can get a better deal just kind of hawking stuff myself. So
Yeah.
maybe direct to owner or whatever.
So did you see that the higher deposit requirement, because for those of you who don't know, the original deposit requirement for the city tax foreclosure auction was $1,000.
Mhm.
So you could go in there with 10 grand and lock up 10 properties. They changed it to $5,000 each as the minimum deposit. Do you think that dissuaded some people from bidding, or what type of effect did you think it had?
Yeah, I definitely think it did. I think you were part of that decision, right? It's telling the city to do it, and we talked about this prior, maybe a year or so ago. There was somebody 2 years ago that came in and they did just that. They must have had $30,000 worth of cashier's checks for $1,000 each, and
Hmm.
they won all these freaking. They won on everything that everybody wanted. Like the top 30 properties they took
Hmm.
down, and they paid
Hmm.
ridiculous prices because they kept bidding and everybody else kept bidding because they
Hmm.
were the best ones available, and then they didn't perform on like any of them, maybe like a couple of them.
Hmm.
So yeah, I think that, because then, like, what is the true value if you've got people that are willing to go in, bid these things up knowing that it's just $1,000,
Hmm.
and then they don't perform? What was the actual true value? So now the city comes back, hey, you were the runner up. I don't really want it because I just bid this other idiot for
Hmm.
$30,000 and he didn't perform. So how about we go back down to where we started bidding against each other, and I'll pay that price. And so at that point, you just say no. You're like, no, no, I'm not doing it.
Yeah.
So I think the city got stuck with probably a lot more than they wanted to 2 years ago.
Hmm.
Last year, they probably got stuck with less, but I still think they got stuck with quite a few. I think inevitably there's always people that show up that don't really know what they're doing. They don't really do the due diligence on the properties. They get swept up in the bidding and in the like excitement of the environment, and they overpay for properties at the auction.
Mhm. Yeah, my idea when I was on the housing quality task force was actually $2,500 per property, and I made the I made the reasoning just as we said right now, right? And I was very surprised when they came, and this was probably the only recommendation they took from a housing provider of 17 years as part of their recommendations. But we'll leave that as it may. But I was surprised they came back with $5,000, and some of the people's comments were in opposition of that on the task force was, well, isn't this going to limit the accessibility of people to buy properties
No,
that don't have the cash? I'm like, listen,
no,
if you know how the city tax foreclosure auction works, you pay the deposit and then you have to perform like 2 days later with
right? Yeah,
with
you
the
have like no
balance.
time. Right. So like they either have the cash or they don't. So if it's
Mhm,
5, 1, 10, it doesn't matter.
mhm,
It's yeah. Here's a piece of advice for people that are thinking about going to the auction. Especially if you're a newbie, don't be the person that goes there and says, "Hey, I am going to win this property," and they just hold their hand up like this, right?
mhm,
Other people are bidding and they don't look around, they don't see what's going on. They just hold their hand up until they win. When
mhm.
somebody does that, people like me and others will just run your ass up because we know you're not putting your hand down, and we will make you pay 20, $30,000 more just because why not? We know you're not putting your hand down.
Yeah.
Put it down. Pretend like you're not gonna buy it, pretend
Uh-huh.
like you're gonna drop it on somebody else. You hold your hand like this, you're an idiot. Public service
Yeah.
announcement.
Well, I mean, you guys are doing a good job to all the junior lien holders that are on those properties, so that
Right.
would otherwise get wiped out through the
Right.
foreclosure process. So,
Yeah.
it's like your public good to make those people pay idiot tax.
Yeah. I would say,
Um,
like, one of the main things that I've taken away, going to auctions over the years is that, like, when you're at the auction, you always feel like you're paying too much for the property. And, after you purchase it, a lot of times you realize that you did get a good deal and you got some equity, but it's kind of based on the current market that you're in, not like the current market you were in during the auction, right? During the
mhm,
auction, you feel like you're overpaying.
mhm,
The next year, after you've owned it, you've stabilized it, you're like, okay, I actually got a good deal. And obviously, it's going to be market cycle dependent, but we've been in this inventory shortage for so long, and prices have been consistently going up. I think that's kind of where the equity is, and that's why people are still going to these auctions and paying what seems to be full market value for an asset they can't even go look at.
mhm. So let's switch gears a little bit. You're in the residential brokerage space. You got your pulse in the market. What's happening out there? I'm hearing different stories from different brokers. I just want to get your take on it.
Yeah, I mean, inventory's down overall, but they say 80% of the realtors do, or 20% of the realtors do 80% of the volume. That's pretty consistent. So I think a lot of these guys that weren't really that established are probably getting shaken out of this market. There's just not enough volume to feed your family.
Mhm,
Um, was it Fannie just announced that you can now do 5% down on duplexes, triplexes, and fourplexes as an owner occupant.
mhm,
Before that would have been 15% for a duplex and 25% for
mhm,
a 3 or 4 unit.
mhm,
So my thought is this just rolled out. Actually, it hasn't rolled out yet. I think it's November 18th that it comes into effect. So
mhm,
for the next season of buying, you've got all of these buyers that have really seen their purchase power go down because of the rise in interest rates, right? So if they were shopping in one particular market, not only have prices gone up, but their ability to buy that house has gone down.
mhm,
And a lot of them just aren't going to settle for living in a subpar, area. Like they don't want to be in this community or that community. They want to be in certain communities. Now, they will have the option to get into a multifamily, 5% down.
mhm,
They'll be able to use the other income to qualify for a higher purchase price. So they'll be able to get back into that market that they might have just missed out on, like the Park Ave market or the South Wedge market, these more trendy hip markets that they were like, I'm done. Like I might as well just pack it up and rent. Like I can't
Mhm.
do what I want to do. Now with this 5% on the multifamily, they're going to be able to get back into those markets.
Mhm.
So I think we are going to see a shift of people that, they wanted the American dream. They thought they were buying a single. They're going to say, hey, you know what? I'll do a 2 to 4 unit. I'll
Mhm.
get my foot in the door. I'll build some equity and then I'll switch to a single family when I can afford it. I think that's going to be the smart play for a lot of people.
Yeah, I mean, I was flabbergasted when, I started winding down my brokerage business back, probably about 4 years ago, and only taking on, like, clients here and there that I really wanted to work with. And, so I didn't really have my pulse on the financing of residential. I did have it on commercial, but not residential. And so I was working with an investor. They wanted to buy a 3 to 4 unit. They wanted to have, like, all their mortgage covered by their tenants' rents. And, I was like, "Hey, it's great. You can do owner occupant, put 5% down, blah, 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 blah." So we around all over the place. And he was like, "No, I got to put 25% down. And plus, like, I'm looking to buy something that needs some work. So that would just blow my cash load." And so we were able to find a program with, I think it was actually Evans Bank at the time, where in certain qualified census tracts, which this property was, it was like right on the edge in the Park Avenue area that they had like a lower down payment allowance on that. But yeah, no, I think that it was kind of stupid for them to adjust that up because I mean we want to encourage people to get their landlord training wheels on and owner occupy multi-unit properties because that's how you reduce housing expense, which is 30% of Americans' income on average, and either cut it in half or eliminate it altogether, depending upon the deal. So I'm looking forward to seeing how this shakes out in the market for sure.
Yeah. Yeah, me too.
Um, well, we are looking for a house ourselves, myself and my wife, and so we're super picky. We're looking for something that's either in Penfield, Brighton, or Pittsford, or maybe the Browncroft area of the city. And we want something that has that's historic, has historic charm and has high ceilings and is maybe 3 to 4 bedrooms around 2,500 to 3,500 square feet. So we've been, not actively walking properties out there just because like we're so picky. We can make a decision based upon just the front picture of the house, whether we're going to be interested in it or not. And so we're starting to see some more stuff stick on the market for longer, and I'm starting to see more price reductions that are out there as well. So what are you seeing on that front in the sort of the owner occ like single family space?
Yeah, absolutely. So there's the savvy realtors, what they're doing is they're not even looking at stuff until delayed's over. Right. So I
Mhm.
think a lot of listing agents are still like, oh, we're doing delayed. We're going to try to get this craziness that we've seen in the past, multiple offers, the price just goes up, 100 grand over ask. That's not happening anymore, right? And so
Mhm.
a lot of these properties are going past delayed negotiations, and that's what the agents are waiting for. So me if I was a buyer's agent, what I'm coaching my buyer's agents to do is like when you're working with a new client in this particular market, what you want to tell them is like, look, okay, if you see something that you really love and it comes to market and it's got delayed negotiations, we'll go see it, but the best play might be to just wait, and then we can see how many offers are coming in when the delayed are due. And if they
Mhm.
say, hey, there's no offers coming in right now,
Mhm.
then, once it expires, then we'll try to sneak in and like get it pretty close to list. Maybe you even pay list price, right? Because list price is better than 3 offers. I'm going 10, 20, 30 grand over asking or whatever. So there's kind of the tact now is especially for people that want to get a better deal in the marketplaces, let's not even look at the new listings. Let's look at everything that's just made it past delayed and that hasn't
Mhm.
sold. And so we're calling those and saying, did you make it past delayed? Yep, you did. Okay, now I'm going to schedule it. I didn't even look at it until your delayed was over. So I
Mhm.
think we're getting back towards a normalized market where listing agents like when I list, I don't even put delayed in anymore. I think it's done.
Mhm. Yeah, no, it's amazing how fast this market is shifting. And, Mark and I do focus on commercial investing, raising capital, marketing, and all that stuff. But it's just interesting to look at the residential market because it definitely can tell you consumer sentiment, in my opinion, getting a read on that. And consumer sentiment ultimately, flows up to, the production level of stuff as it relates to, retail. So it's like if consumers are feeling less confident, they're feeling like they're getting pinched, then they spend less money, and retail space becomes less desirable. And kind of the whole chain there. So I always study that market closely because it gives me a good sense in terms of decision making and where opportunities might lie in the commercial side of the space too.
Yeah.
Um,
I've looked at
so,
quite a few commercial recently, and it's still like unless you're buying it like 60 to 70% loan to value, there's no deal to be had.
mhm,
You know, the you just can't make the numbers work with bank financing at anything higher than 60, 70% LTV. I have found one, which I think I haven't seen it yet, but the numbers look good. You could actually bank finance it at an 80% LTV with, not needing to bring any extra equity. It'll still hit your debt service.
mhm.
So,
Yeah. Speaking of debt, I have people that are in my mastermind and mentorship program, and I see term sheets a lot because I have my students that say, "Hey, I got this term sheet from this bank. What do you think?" So I kind of like aggregate that, and I'm like, and I'm just seeing like banks starting to pull back as well in terms of lower LTVs, regardless of how good the DSCR is.
yeah.
From that perspective, and also pulling back on the amortizations as well.
Yeah.
20, 25, I was seeing 25, 30 year amortizations. Now I'm seeing max 20-year amortizations on deals. And also fixed interest for shorter term, like 3 years. I was really used to seeing 5 years fixed from community banks.
Hmm.
I know the whole mantra is survive till 25, and hopefully that rates will normalize. But I think that that banks are trying to hedge their interest rate risk as well in the event that interest rates stay higher for longer. Because if they stay higher for longer, that's sucking more cash out of the market as well.
Yeah.
So, um, so switching gears again here on the fund space, where you're at on that. Do you got your documents all like negotiated and lined up yet, or is that something you're still working on negotiating?
No, I'm still working on it. Yeah. I I've been sick for a few days. That wiped me out, and then dealing with a few other projects that need finished. So it's on my
Hmm.
list this week, though, for sure.
Yeah, no, I'm looking forward to the fund launch for sure. I think that you definitely don't need to move all too fast because I'm looking at GPs raising LP equity, getting a lot more aggressive on trying to get commitments out there.
Mhm.
So which is telling me that they're having a hard time getting subscription full subscription to deals. From a capital raising perspective, I think that people, the investors out there are kind of like pulling back. I think they're looking at risk-free rate of return being between 5 and 6%. So, I think that I'm hoping that there'll be opportunities out there in the market. The work that I'm doing right now is, we're looking at deals, we're making offers, but most of the work that I'm doing is on talking to our investment partners and just keeping them in the loop, letting them know that I still exist,
Mhm.
and what I'm seeing out there in the market, and just letting them know is like, hey, I don't think that the market has really gotten pure price discovery yet. I don't think that we've worked the inefficiencies out of the market just yet, but I want you to be prepared because when there's opportunities that come up, they're going to be great opportunities when we start seeing some of these asset values come down to a place where we can uh, buy properties and get a good basis on them.
Are you looking for multifamily, or are you sticking with the office right now for what you're underwriting currently?
Um, Good question. Office was something we were really bullish on, while bank financing was still, reasonable on it. We were getting great smoking hot deals on office with a great tenant mix, long-term leases, a lot of government tenants, and we saw that our LTV term sheets went from 75% loan to value down to 50% loan to value.
Ooh,
And we'd ask another bank, 50% loan to value, 45% loan to value. So we kind of took a pause on that because we think that, all right, well, if the capital markets are like sucking liquidity out of this asset class, we certainly don't want to. I mean, I'm not afraid to catch a falling knife. I have caught a falling knife before, but I've had a long enough business plan and patient enough capital to weather the storm. But this is wanted to see the writing on the wall, where I think that there's going to be further hurt on the office sector
yeah,
going forward. Because if I have to raise the extra capital to come, to do a 50% loan to value, that's fine. But I want to get a really, really great basis on the property as a result of
right,
that.
yeah,
So that being said, would love to get back into multifamily. Would love to. That's my background. That's the business I know how to really, really add a lot of value to. I'm not the type of investor that wants to smack it out of the park every time. I'm okay with a single and double, as
hmm
long as we have, very, very manageable risks, because our business as capital raisers is in risk management, period, full stop.
yeah.
And so I would love to get back in a multifamily. I just don't think, we don't have an environment, at least in Western New York, that is creating the amount of stress that we've seen in those higher growth markets like Seattle and Arizona and different markets in Texas and that sort of thing. So we just don't have an abundance of motivated sellers, for instance.
I
Um,
know. I find it strange too because we have such strict, laws, tenant favoring laws that I would expect a lot of people to get disheartened with this area and put up the peace sign.
yeah, I mean, the thing is that we go after assets that have, really, really great, strong tenant bases,
Yeah.
and
Those people
reposition.
are never selling. Yeah.
Yeah, and repositioning those properties. So
Yep.
I have opened up, dialogue with property owners that own 200 plus units around this area, and
hmm
just saying, listen, I know that you're not motivated to sell right now, but there's going to become a point in time when you are going to need to exit, and we're here to
Right.
provide a long-term customized disposition strategy for you. But in order to have the most advantageous outcome for you, it's good to have, start the conversation and relationship early on, so you can understand what your objectives are, and that so we can properly align with those objectives when you are ready
Right.
to move on to something else. So I do think that, in Rochester, the owners of these larger multifamily apartment communities, they're not your institutional, private equity syndications, that sort of thing. These are, I wouldn't call them mom and pops. They're like, well, they may be your country club mom and pops, right?
hmm
There's a very, very small amount of partners on those deals. Usually, maybe 2 to 3 partners on a deal. Not a syndication with with a like where they have a terminal value with a certain time that they have to sell the property, return capital back to their investment partners.
Right.
So I think that those conversations need to start early on. So if you're listening out there, and you
hmm
know anybody that owns 100 plus unit multifamily apartments in Western New York, definitely I would appreciate an introduction, because that's the type of conversations we need to have right now, not when you're ready to sell. Just like in capital
Right.
raising, the best time to ask for money is when you don't need it. The best time to structure a sale is having the conversation as early on as possible.
Absolutely. Yeah. I feel like I've missed out on a few by not taking that approach, not
Hmm.
keeping the conversation going, then finding out that, oh, actually we sold it, and you can tell if they've owned it for a long time. And, I've seen on multiple occasions where it's like a bunch of like three brothers or two brothers or like two attorneys or, like friends that are professionals together that have done stuff that have built
Hmm.
it, maybe built it themselves, done some repositioning, and they've held it for 20, 30 years. And you just
Hmm.
don't know when they're going to sell it, right? Because they could keep it for 10 more years or they might just be ready to sell it now. You just don't know.
Hmm. Yeah, the other strategy we're looking at in terms of deal flow is identifying affordable housing developers that either substantially improved or built a project less than 15 years ago. like around like, let's say 13 to 14 years, typically those affordable housing developers, they make their money on the tax credits. All right. So
Mhm.
they have a big pot of money with various different funding sources. They make their money on the developer's fee on the front end, and then those tax credits burn off over a 15-year period. At the end of that 15-year period, they have to pay their tax credit equity investors back, which usually triggers a sale. And they really don't care what the asset sells for. Their objective is to return the capital back to their tax credit investors. So there are some deals out there. One of them was actually a student of mine, that there was the tax credit equity burned off, and there was no other tails attached to the property from a regulatory standpoint. So he was able to get a smoking hot deal on that apartment building as a result of that.
Nice. And that was his own due diligence, like looking up when these things were built and then finding who to talk to. And he did that cradle to grave.
This was actually an investor, another investor that knew about the deal, that wasn't quite their cup of tea, and knew this particular investor that I was working with, like, carved a niche out for himself in a certain neighborhoods of the city and that sort of thing, and
Mhm.
has a really great management track record, great investment track record, and so he was thought of in terms of top of mind there. So
Nice.
I think that, another thing too is that regardless of where you are in your business, is that having that niche, because in terms of you know the reticular activation system, as David Green says on the Bigger Pockets, when people know what you're looking for or what your niche is with the highest
Mhm.
degree of specificity, then when they see it, they think of you, right?
Yeah.
The last thing you can do, and you probably work with investors, right? Like, as your
Mhm.
clients. All right, what type of deal, in terms of your onboarding with that client? All right, what are your objectives? Like, what type of property you want to buy, what location, blah blah blah. And they're like, hey, anything that makes sense. I'm just gonna want to make a deal that makes money. All right,
Yeah.
you tell that to the world, like, nobody's gonna send you anything.
Never. Yeah.
But if you say, I'm looking for, uh, 4 to 10 unit properties in the Southwedge neighborhood, ideally that have, shingled roofs and brick exteriors, with parking, then that's something that somebody they can stick in somebody's memory.
Absolutely.
That with that, so that's always a thing that I love
That's so
to coach
true.
people on.
Yeah, when I get a deal, that's exactly what I do. I see, okay, which one of my investors has told me that this is what they're looking for, right? So if
Hmm.
you're the investor that's just like, I just want to make money, it's like, okay, you're not in my mind share of calling.
Hmm.
You just aren't.
Yeah, no, absolutely. So, talking about your fund launch, have you thought about or have like ideas you want to riff on about like what your like marketing strategy is going to be for that fund in order to get the capital raised for it?
Yeah, I think the marketing strategy will be predominantly based on my track record in the foreclosure markets,
Hmm.
showing examples of what we've done in the past, kind of walking people through the various different options,
Hmm.
right? Because it's not just one methodology in the foreclosure market. It could be something like a single family flip that you pick up in a suburb like Pittsford or Brighton. For those
Hmm.
people that aren't from Rochester, like these are the best school districts, where you can get something one off. You don't know when you're going to get it. Maybe you get one a year, two a year, three a year, whatever.
Hmm.
You'll have that avenue, and when it surfaces, you take it. And
Hmm.
maybe you could put 100, you could get 100 grand equity through
Hmm.
that process that can help the fund.
Hmm.
But then you've also got the strategy where you're looking for distressed value add, and that
Hmm.
could be just a mismanaged property that fell to crap, and then the owner just didn't care because the taxes have rolled up on it. They haven't been collecting income, and their best move is just to walk away.
Hmm.
So you'll have those kind of things, and a lot of the other debt will get wiped out depending on what kind of foreclosure it is, right? So if we did a tax foreclosure, anybody is just going to get knocked out. So we can get a pretty good deal on that. Even if the taxes are high, at least we're getting rid of the rest of the debt.
Hmm.
So there could be that value add where, we're going to need the capital for the acquisition. We're going to need capital for the value add, stabilize it, and then refi it. Um, so, and it could be anything in between, right? It could be a two family, a four family, a 10 family, 100 unit. So it's pretty versatile.
100%. Something random that I had on our topic for discussions today is uh, the sub two movement. Have we talked about this yet?
We've
On
touched
the
on it a little bit. Yeah. I'm happy to dive into it though, because
okay.
it's crazy how much traction Pace has made in the marketplace as far as like just marketing. And I think sub two, in my opinion, it's just a good marketing term,
Mhm.
really.
Yeah. So a little story. I may have said this on the air before, but I went to the Bigger Pockets conference this year, and there was a meet and greet with book signings, that sort of thing, that was available. So you could meet like all these rock stars that are just like, you're like people that are just monumental titans to me in the real estate space, like Matt Faircloth and Brian Burke and Andrew Cushman and Brian Murray, who's Brandon Turner's partner with Open Door Capital. And nobody was like standing in line to talk to these people. I hogged them to myself. Like it was amazing. And I saw this line that just went around in circles and circles and circles. And I was like, who are these people waiting to meet and greet? And I walked by and it was Pace Morby. Like, there was like hundreds of people that wanted to meet Pace. And I think that, I really, really want to, understand the secret sauce of his marketing, because like he kind of just came out of the woodwork, like out of nowhere. Right. And then just
Yeah.
became this household name. The one thing that I have concern with anything that's like becomes, any, there's always cycles in terms of what the new hotness is in real estate
Yeah.
investing, right? Years ago it was fix and flip with the HGTV shows. And then you had all these, people that came out selling programs and boot camps around, fix and flipping. And then, the margins got squeezed out of that because there was tons of people that got involved with, fixing and flipping. And then it became wholesaling, and they had wholesaling boot camps and that sort of thing. And then it became short-term rental, then short-term rental arbitrage, then it became midterm rental, then it became, land flipping, right? And now it's this like sub two thing. And there was like people that had sub two hats on, sub two t-shirts and all this like, all this like merch and that sort of thing. And I think the dangerous thing here is that when you have something that, and I don't know how much his program costs, but due to the amount of people that were in the sub two community, I think it's probably like, maybe a couple grand or something like that, $2,000-3,000. People that I've been in this position, right, with $1 and a dream. And I've seen what happens when you're taking ownership of somebody's property with none of your own money, because a lot of these people, like, they just spent their money. The only money they had was on the entry fee for this
Right.
program, right?
Yeah.
And they just took over somebody's property, thinking the rent was going to be $2,600 a month on this property, and the mortgage, let's say, was $2,200 a month. All right, and including taxes and insurance, that sort of thing. And lo and behold, they put it up for $2,600 a month, and they can't find a tenant. Right, so they're like, okay, well, I'm making these payments. I can drop the rent to where I can rent it out and stop making the payment because I don't have any skin in the game. And I made these like kind of like open critiques on, I think that Pace Morby is going to make sub two illegal because of the amount of marketing behind it. And I got so many attacks from people, like they were just evangelical for the sub two community, and like, Pace trains us on how to, protect the buyer and also protect the seller and blah 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 blah. I was like, yeah, but there's always, when you have this amount of like, cultural like movement, it's like it's incredible. There's always going to be bad actors out there. They're going to cut corners, and it just takes a handful of people. They got foreclosed upon, little old ladies. They got their credit racked, and
Hmm.
now they can't get utilities in their name because of of what just happened. Had no recourse at all in the process
Right.
to tell their senator, hey, I got scammed by the sub two thing. What sub two? What is
Yeah.
sub two? And
Hmm.
then I'm calling it right here. I think we're going to see Pace Morby on Capitol Hill testifying before Congress as to what sub two is.
Yeah.
Seriously.
Yeah.
Um, but that being said, I think that I was talking to somebody that's been in the sub two space for a long time, because it's been around. It's not anything that's
Yeah.
new. It's the marketing that's made it new. And
It's the interest rates too, right? Because now everybody's attracted to these 3-4% rates. They can't get them anymore. So I think that's really what's propelled the sub two movement
mhm.
just leaps and bounds. I mean, sub two is cool, but sub two, when you're stuck in an interest rate environment of 8% and you can get something subject to at 3%, then you're like, okay, let me try to make this work.
Yeah, and generally these people, the reason why they're selling it subject to their mortgage is because they're underwater.
Right. There's something wrong. Something's going on.
Yeah, like why would somebody just like, okay, I'm gonna sign the deed over to the house and I'm going to trust you to make my mortgage payment after you take title to the property.
Yeah.
There's always something that's like, hey, it's a great interest rate, but the property's underwater by $100,000. I can't
Right.
sell it.
This is
I
like this is like wholesaling 2.0, right? Everybody got into wholesaling because you didn't need any money. You could try to make some money. It's the new craze. It's
Mhm,
like you said, they got $3,000. They joined this program. They're gonna make $1 bajillion doing subject to deals.
mhm,
I think exactly what you're saying is true. There's gonna be not necessarily intentionally bad actors. There's gonna be people that go out there, they find something, they think they know what they're doing. They actually have no clue what they're doing. They make a huge mess and it blows up in everybody's face.
mhm. Yeah, and I think that the way they'll make it illegal is all they have to do is Congress has to pass an act that does not allow title companies to legally allow transfer of ownership without there being a payoff or
Distraction.
an express written um,
Consent.
uh, consent by the lender to
Yeah.
assume the mortgage.
Right.
And they can make it illegal for attorneys to do it as well. I mean, and attorneys aren't going to do stuff that's illegal.
Right.
So I think that's where you're going to see that. And this is the thing is in terms of the education space, because I'm in the education space in terms of like, teaching people how to do, scale into larger commercial deals. Um, the usually what you see is in these trends is the reason why there's educational product out there. It's the person's like last bite at the apple because the market has caught on, brought efficiencies in the market, brought more people in the market doing the same exact strategy, and they're just trying to capitalize in the back end to kind of get their last bite at the apple before it blows up and it becomes not popular anymore. It's just
Yeah.
my opinion. The reason why I think commercial will never be popular is because it's freaking hard. So
Right.
um, it takes a lot of energy to make traction in the commercial larger deal space. Just period.
Mhm. Yeah.
But I guess we'll
I
see.
just my plan has always been just take baby steps, you're right? Just small steps. So, I'll keep
Don't
taking
take
my
baby.
small steps.
Don't take baby steps. You
Well,
gotta go. You
not
gotta go.
baby
You gotta
steps.
go bigger. Go bigger.
A baby step at a time or one step at a time.
So, um, but cool, man. Well, sounds good. We're close to the top of the hour. Do we have somebody
Yeah.
scheduled on for next week or what?
Yeah, we do. Our calendar's full. It's just, with the live event, if somebody cancels at the last minute, it's tough to find somebody to swap in.
Yeah.
So I
Um,
didn't mind doing this with you though. I thought it was a lot of fun.
yeah, I definitely great to have Justin rescheduled and on the calendar. I was actually on Justin's podcast. It was so coincidental. He just dropped my show that I recorded with him probably 2 to 3 months ago, like
Okay.
this week.
Nice.
And then like literally like 15 seconds after I got the notification that the episode was live with like, his like social media reel that hey, if you can want to share this in your social media,
Mhm.
I got that email. I was like, Justin Dixon, holy crap. Like what a small world.
Small world.
But cool, man. Well, sounds good. I'll look forward to seeing you next week and we'll keep on
Yeah.
rocking, being the misfits of
Yeah.
real estate.
Misfits are real estate vendor night tonight. If you're local, Rochester, even if you're not a member, come as a guest. It'll be a
Yeah.
good
We,
time.
we have a monster amount of registrations for the event. We'll see how many shows up. I've been using paid social media ads through Facebook to promote the event. So this has actually been like I've been teaching myself like how to run paid social media ads, like through watching YouTube videos and
Mhm.
all these like free courses and that sort of thing, and kind of experimenting and that sort of thing. So I used, I think it was like 3 different ad creatives for it, and I used broad targeting for the greater Rochester area. So I
Mhm.
didn't before. I used to target on like interests, real estate. I wanted to get people that are interested in real estate, and I was like, how does Facebook even know that? But the Facebook ad machine is powered by artificial intelligence. So, the people I've been listening to and watching are like, just let Facebook's machine learning do its job. Don't try to micromanage it.
Okay.
I've employed those tactics that I've learned over the past month or so to promote this event. So we'll see how it turns out tonight.
Yeah. I got a brand new lens in the mail today. I got the Nikkor the Plena,
Oh,
which
okay.
is like flagship portrait lens. So I'm really excited. I'm going to bring it to the event. So if you're there and you want a shot, just let me know. I'll get you a nice picture, nice new headshot.
All right. Awesome, Mark. Sounds good. We'll see you tonight.
All right. Thanks, guys. We'll see you next week.